Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, we were just chuckling about something a couple of minutes back with my guests today, and I'll introduce you to them in just a minute. But if your SIP date was either on the 5th of this month or on the 10th of this month, then you will be quite happy looking at the way that the markets are starting out this week. If, however, your SIP date is on the 15th or later, then, well, you've missed out on the advantage that you could have had if it wasn't. Now, the thing about it is that seemingly, based on the AMFI data, that is the Association of Mutual Funds in India, and the data that they put out for the month of March and April, a lot of people are gravitating towards ETFs. In fact, last month, you had net inflows of over 19,000 crore rupees in other ETFs, which is primarily equity ETFs. And that told me that a lot of people are looking to buy the dip. And there is a considerable amount of money sitting on the sidelines for people to buy the dip. If you are going that route, what should you bear in mind? That's what I'd like to focus on at the start. And we'll also talk about a few other ETFs, including gold and silver. Joining me today is Prableen Bajpai, founder of FinFix Research and Analytics, as well as in studio, Santhosh Joseph, the founder of Germinate Investor Services. Thank you to the both of you. And well, I know that a lot of your clients will be happy if you've told them, and I'm pretty sure you did, to stay invested over the course of the last couple of weeks. Prableen, since you're not here, I want to start with you. What did you make of this data? I'm sure that you looked at it, 19,000 crore rupees. If you pair that with the index funds, then you're very close to the net inflow in active equity schemes.
Absolutely, Alex. Amazing figures, I think. If you look at the overall data for passives in India, it is still at 17% of the overall AUM that we have. And within the 17%, Alex, roughly 75% is your ETFs and the remaining are index funds, because ETFs, get a huge backing from the EPFO money as well. So we are at 17%, but very interestingly, on the month of April, I think brilliant start to the new financial year, where we saw that the passives actually with the ETFs leading the way actually got huge inflows. And I think the reasons why we saw this is definitely the volatility that we saw in the month of April, because sophisticated investors who are putting in big money have, sort of gotten to understand the merit of ETFs. And I think they are the ones who definitely have taken the advantage of the volatility that we saw in the month of April, especially the dip that we saw on the 7th of April. And second is that we have many new offerings in the ETF space as well. The overall other ETFs was about 189 schemes, inclusive, of everything in the other ETF space as on in April 2024. And it is now at 233. There is a substantial increase in the number of schemes, offerings, awareness, DMATs. And I think all of this, Alex, together has definitely, led to this rise in the month of April, which is also because there is a chance to buy during the day. So the INAV, when you're buying during the day, you can actually pick your ETF at the day's low as well. So I think sophisticated investors who are putting big money are definitely going in for the ETF option. I won't say that it is, anything to do with the huge inflow coming in from the retail segment. I think they are the ones who are actually helping to keep the SIP book, which again was really huge, the highest till now, more than 26,000 crores. That has been robust. And that is where I think the retail investors have played their part. And I think the ETFs has been broadly because of the high net worth individuals and institutions like trusts and companies as well who are putting in.
Point. Yeah, okay. And I'm pretty sure that you have that insight because you have people that you advise as well, retail investors. But Santhosh, I want to come to you on another aspect, and we'll circle back to ETFs in just a bit. But another data point that I looked at is that you had net inflows to the extent of 2,000 crore rupees in sectoral and thematic. But if I looked at the breakup of gross inflows and redemptions, then it's something like a 10,000 crore rupees of gross inflows and redemptions of about 8,000 crore rupees. So seemingly there's a lot of churn in that sectoral and thematic category. One, what are you advising your clients to do to stay away from certain sectors? Because it's a little bit of volatility, to put things lightly.
Yes.
Right? And the IT index, for example, is up 6% today. How do you deal with that?
So the whole thematic story had a great run, 2023, 2024. And when we saw the data for the number of NFOs in the year 2024, you had 70% of the NFOs coming in only from thematics.
Yeah.
Now, this is not a surprise because the market was building up for thematic expansion, because a new NFO could largely be done only in a thematic space, and there were broad themes that were doing well. Could be defense, could be manufacturing, and at some level people were also looking at a mix of 2-3 big sectors to create a theme. Come September, October, when the market started the first level of consolidation to where we are, and the consolidation turned a little bit violent in Feb and March, people realized, hey, there's no easy way to play the market, and thematics is certainly not one of them. And people paused first, and then they started consolidating.
Yeah.
So what they did was they moved away from thematic and said, if I wanted to play a theme, I rather play it in a broad-based story than just be in a theme and just worry about, will my theme play out or not? A classic example here was defense. Today, as we sit in the studios, defense is now back, and for all its difficult days it went through, it's just wiped away all its bad days. But people were spooked to see where defense unwound in just a few weeks. So then they decided, why do I have to play a thematic story? Let me play it in the diversified fund like a flexi cap or a multi cap. And they saw the capital preservation also was better played out in a flexi cap and a multi cap story. So thematic needed that bit of nudge to get consolidated. It could not be that thematic was going to become so big, and great way to bring about this change.
So now at this juncture, knowing what we know right now and not knowing what we know right now, what would you say you should stay away from? Or do you say that thematic as a category, considering where things are, the uncertainty about earnings going forward, all of these things that we're talking about and keep talking about, should you avoid?
See, I'll give the answer in a slightly different perspective, that thematics are great and the products are there for a certain discerning investor. Now, for the larger investor, the thematics are actually being played out in diversified equity schemes. Could be flexi cap, mid cap, why not? Mid and small cap also, it's played out there. Us jumping into products and solutions directly without paying heed to the portfolio construct is where the problem arises. And investors have learned that pretty quickly.
Sure.
So my sense is, don't chase the theme or the sector. You be invested, and the fund manager or the scheme will dynamically manage. See, the economy is changing, the sectors are changing, and the valuations that these sectors are getting are changing. If you go after one sector or one theme, you're more or less going to be left out at some point of time.
Sure. Okay, that's a good answer. Prableen, I'm circling back to the ETF chat, because I think a lot of people are buying into this idea of going passive, at least for a portion of their portfolio. And you and I have discussed this in the past in the mid-cap actively managed space in particular. If you look at over the last 3 years or over the last 5 years, in quite a few time periods, the actively managed schemes have failed to beat the benchmark. And so therefore passive is better, particularly post-cost. But between ETF and index fund, how do you choose which to invest in?
Absolutely, Alex. I think the decision involves analysis at 2 levels. So the number one being that you have to choose between the ETF and the index fund. And then you also have to choose, let's say you decided that I have to go in for an ETF, then how do you choose between the 2 different ETFs from the same theme, amongst the different fund houses that we have. So I think four primary filters here. The number one is what is the price difference between the indicative net asset value, the INAV, and the market price. That's really important. So if an investor is going out and, you can check that on the NSE portal, that what is the market price, what is the INAV, and, what is the difference between the two. And the lesser, the better. So that is the first criteria of choosing a ETF. Second, the traded volume. Alex, that you don't want to be caught up in an ETF where there is really no volume, because when you're going to buy and sell later, let's say you buy something and then you're looking to sell it, maybe you don't get the price that you're really looking at. And again, the volume numbers are given on for example, if the ETF is listed on the NSE, it will be given. And for today, I'll just give you an example that, how it varies. So I saw 3 big Nifty 50 ETFs. and it was around noon, 12:15 in the afternoon today. That scheme A had a volume of 47 lakhs, scheme B had a volume of 3.99 lakhs, and scheme C had a volume of about 14.09 lakhs. So that's the kind of difference within the same Nifty 50 ETF that we saw. So again, this becomes really important because it guides how much liquidity is there in the ETF. And then the liquidity actually creates the problem of the hidden cost, which is there, which we call the impact cost. That will your transaction go through at the price that you're wanting? So that's the cost of execution, of a ETF. So again, for scheme A, because the volume was higher, it was 0.02. For scheme B, it was 0.07. For scheme C, it was 0.05. So these three, in these orders, I think you should go down. And the fourth one is then the expense ratio. And what happens, Alex, generally whenever we are talking about an ETF and an index, the first answer is that ETF is cheaper, so I think ETF is better. It's really not the case. For retail investors, I think, do they already have a demat? Okay, then probably they are okay with the brokerage. Do they want the automated SIP? Then probably an index fund is better. Are you able to, really choose the right ETF for yourself? That is really important. So difference between, deciding between the ETF and the index will really depend on your own psyche or what sort of convenience you're looking for. Do you want it to be totally automated? And then when you're choosing within these ETFs, then I think these four criteria are very, very important for you to be able to actually gain from buying an ETF, because there are cases in which, and I'll discuss that later, when we discuss gold, where the expense ratio of the highest ETF, the fund which has the highest expense ratio actually has the maximum volume. So, it'll be wrong to say that, you jump onto the fourth factor of expense ratio right away and then decide. But of course, the decision between ETF and index would really be a personal choice. I would say for retail investors, for SIPs, index is better. For lump sum, definitely you can look at ETFs as well.
Interesting. And ultimately, it boils down, that impact cost, as you were talking about, Prableen, boils down to the bid and ask spread. Whenever you go into a market, ultimately, if you are the seller, you will ask. If you are a buyer, you will bid, and you will get essentially a certain value. You will have to come to a common ground. And if there are less buyers and sellers, then usually the gap between the bid and ask will be larger, which I guess is the impact cost that you were talking about. But Santhosh, the question then arises, if you're talking about a bit of complication when you're talking, it's pretty simple, of course, when you're going onto an application, you're buying, but then you're not factoring all of these things in. In your experience, is there a material benefit to be had to using an ETF versus an index fund, purely from the perspective of being able to say at 12.22, I feel that the index is at the lowest point of the day and it's, 3.5% lower, I will deploy at this point?
So I think Prableen did a great job in explaining those difference between index and ETF. This question that you asked is the precise reason why ETFs offer a solution to client, that during the course of the day, he feels that he wants to put money in the market, doesn't want to worry about the NAV at the end of the day, doesn't want to worry about what can happen overnight, he wants to buy it today. And the liquidity plays a big part, and especially for a large investor, the investor who's got access to the screen directly, these things are beneficial to you. So essentially, it's not about the cost, it's not even about whether it's ETF or index, because there are index on ETF and ETF on index. These things are all easily possible. But I think the benefit is that the investors got something to choose from right now, especially like today, or maybe earlier in the day, you thought the markets opened green and you wanted to buy into it. You have to wait till end of the day, see the NAV and the whole story, right? Here you bought in, and maybe you would go home before 3:30 today, seeing that some gains were already made. That is the luxury, advantage, and convenience that ETFs give to an investor, and some people are happy about it. They take great joy in getting the price right or getting at the price.
Does it even out?
Of course it evens out. In fact, if it didn't even out, then ETFs would be bigger than maybe funds and index, because the initial feeling that you get is you've done something right and you got the price right or the timing right. But eventually it gets evened out, and you'll be surprised to know that expense ratio pales in all of these comparisons, because there is no data to prove that high expense ratio or low expense ratio is contributed to higher return or lower return. I'm yet to find across a credible piece of evidence that tells me low expense ratio gave me higher return or high expense ratio gave me a lower return.
Passive?
The choice between passive, index and ETF, the category is very different, but even in passive, it's, Prableen explained, even the volumes that play out,
sure.
there is that minor advantage you get. It's basically economies of scale. Now that is there for the investor depending on how you placed your order, but I think they pale in comparison.
Okay, I will get your opinion on this next part as well, but I want to start with Prableen on this. Prableen, that other ETF category you pointed out, there are several options within this, and the smart beta options have caught the fancy of a lot of investors. I just want to explain this point very simply in case you are unaware of what smart beta is. Essentially, it's a strategy in the passive space which obviously does not involve active choosing of securities from within an index. And there are filters that are applied. For example, a momentum filter is applied, or an alpha filter is applied, or a low volatility filter is applied. And there is a reset every few months, usually 6 months, and you will invest in that ETF. So hopefully I've explained it. Probably if you want to explain more, you please go ahead and do so. But in your opinion, have these strategies worked? We've gone through a micro cycle, if we can call it that, between the run-up till September of last year, the drop, and then the bounce back. How have they done?
Okay, so I think I've shared some data with you, Alex, and I'll just pick, two strategies here just to make it easy. So number one, let's discuss the equal weight strategy. So Nifty 50 is the parent index. So bigger the company, bigger the market cap basis, you have a bigger share. Now, a simple strategy index here is Nifty 50 equal weight index, where all the top 50 companies are getting the 2% allocation. So it's like the Reliance Industries or Nestle, any large cap will get the same of the top 50 companies. So if we look at the dip from September 26th till April 7th, Nifty 50 fell by 15.5% and equal weight fell by about 17.75%. Of course, the rally now, Nifty 50 has gone up by 8.33 and equal weight has gone up by 7.44. So that's how the two indices have moved. But if you're looking at the 7-year SIP returns here, Nifty 50 has given us 13.82% returns and equal weight has given us 17.05. So that's quite a decent difference, Alex, between the two for a little variation in the strategy that has been deployed. Likewise, if you look at the Nifty 150, the mid-cap index, again, fell almost 19.5%, 20%, has moved up by close to 9%. Like today's closing, of course, it will be much higher. And the 7-year SIP has been roughly about 21.5%. And Nifty 150 Momentum 50, because here the momentum filter is applied, fell much more. It fell by about 23.5%, but has been up by close to 10% as till last Friday. And SIP returns have been at 26.18%. So again, there has been, it has been more than the parent 150 index. So we have different variations. We have the alpha index, we have the quality, we have the low volatility. Not all of them have beaten the parent index, but there is a good scope to add, I think, a smart beta strategy or a strategy index, but not in addition to the core. In the sense that if you're having a Nifty 50, then you don't have to add Nifty equal weight. Or if you're having a 150, or if you're having a actively managed mid-cap fund, then you don't need this momentum. Then you have to look for the gaps that maybe you can take a beta strategy in the large mid-cap space. So you have to find where there is a gap in your portfolio and accordingly deploy. But I think one or two strategies, which are these strategy indices, definitely I think they can be there with the rise of passives and the addition of this little alpha that they are actually giving. I think it can be a good idea, but based on the suitability of the overall portfolio.
To that, I want to get Santhosh's opinion as well. Santhosh, so Prableen's taken a 7-year SIP, and that also tells me that there is a longevity associated with this. We've used a pretty decent time frame to talk about this, and I know that over the last several years we've had this challenge where some of these strategies just didn't have the data. They were introduced, and so you couldn't, of course you could back test it, but you didn't have actual data. So when you're choosing between a Nifty 50, Nifty Next 50, with a lot of people gravitate towards, then you go to the mid-cap index and you go to the NSE 500 or the Nifty 500 index, and then you throw these smart betas into the mix as well. There is paradox of choice here as well. How do you choose?
Well, I think Prableen again explained it really well. Now, when you come to this, why did this come about? Because investors wanted a shortcut to success, a shortcut to getting a successful fund. And I agree again with what Prableen said, that over a period of long term and over a period of a slightly larger cycle, especially in a bullish scenario, these will play out way better than just the regular index, because there's active selection, there are rule-based filters that work in your favor. A classic example is momentum, and most people would like the name, maybe would even like the outcome of what momentum has done, but you don't know it cuts both ways.
Yeah.
For example, the same momentum that outperformed the index, outperformed diversified funds, up until September was even doing so well that everybody thought, okay, this is my way to do better than anybody else. In the last 7-8 months, we've seen that went through a couple of cycles, and it cut both ways, where people realized, hey, I cannot blindly buy into a momentum strategy just because the past performance is good, because it happened in a bullish cycle. Two things were happening there. Number one, the momentum was in your favor in terms of the traded value. Number two, the alpha generation was happening. You know, when you mix these two, the momentum 50 or momentum 30 or 40 stocks that you did, they played really well because there was active selection and active deselection of the non-performers.
Yeah.
That helped you do well. And when the market started falling, the guys had done well, their volumes also started falling and the performance fell. You realized that you were hit, and you didn't realize what hit you because it was the same factors going against you. So then I'll go back to the answer over here. There's no shortcut. Either you stay long enough or you understand the risk these things entail, and you have to figure out, why am I buying this? So traditional diversified multi sector strategies still score over these strategies. Yes, they have an edge, especially for a discerning investor, whether you're doing an SIP or STP or you want to stagger out, they do give you an edge. But remember, it's not a shortcut.
Okay, but so then to answer the question, would you say that therefore Nifty 500 is a great place to start?
I'm glad you asked, because my favorite passive and index strategy is actually the Nifty 500, because one, I'm not a big fan of passives generally as in my personal disposition, but I like the Nifty 500. Now let me tell you why. It is the top 500 stocks in the country. Now when you talk about profit pools, I think guess would be anyway more than 95% of the corporate listed India's profits are represented over here. By and large, the most widest institutional activity in India happens in the top 500 stocks. And when you buy the Nifty 500 from a large cap is fully covered, mid cap is fully covered, small cap is very well covered, no stress, and this is a de facto buy India strategy playing out for you. You can be an FII and it will work well for you. You can be a retail investor and it will work for you. So I'm glad you asked that question. Nifty 500 is my great strategy, especially if someone who's watching this show for the first time or someone wants to start investing in the Indian equity market, because there's a dilemma. Should I go aggressive in mid and small cap, or should I go conservative in large cap, flexi cap, multi cap? Nifty 500 is the best that you can get out there. Stay put.
Okay, Prableen, do you agree with that? Would you say that that is the best option, or do you say that a diversification here as well makes sense?
No, I think Nifty 500 can be a great start, Alex, but not for somebody who's already planning to buy, let's say, a large cap index or and a mid cap index separately, because then it'll lead to a lot of duplication. But I think for those who have active funds, let's say in the large cap and the mid cap space, for them, I think Nifty 50 can be a great inclusion from the passives. So then it would complement the active strategies. So that is definitely, I would agree.
Okay, so we're running out of time, but I do want to cover this very quickly. We have a couple of minutes. Santhosh, would you say that investing in gold and silver ETFs at this juncture makes sense, particularly because of the kind of changes we've seen in the recent past? The data from the last couple of months points to people pulling money off because net flows are negative in gold ETFs.
I'm happy that the last 1 or 2 months net flows are negative, because usually investors chase return. The last few months have been phenomenal for both gold and silver. The last 1 year and 2 years is staggering. People taking off money, I think at some level is a sign of maturity, that people are not buying the high but selling the high. We seldom see it. On the other hand, I don't say you shouldn't buy. I think you should buy for the right size and for the right reason and for the right time frame. If you're going to buy gold today because it's going to be a part of your portfolio and you want to keep it for strategic reasons with your portfolio, you buy, but don't chase the return. Data is out there saying that investors are selling, actually taking profits off the table, because gold never usually gives this kind of returns. You know, 20-year, 10-year averages are at 6% and 5%, and now we're sitting at some high double-digit numbers. Very good.
Okay. Prableen, would you say that SIP is the way to go on gold, considering that you should have it in your portfolio?
Absolutely. I think, Alex, for retail investors now with the taxation becoming favorable at 12.5%, I think SIP is the best way because gold can be quite volatile. If we looked at data, in 2015, 16, 17, there will be periods where, there have been negative returns. SIP returns can be as low as 3% for a 2-year period. So number one, that investors have to be prepared that even with gold, there can be phases of frustration where you may feel that it is not performing. But I think if you're investing in gold, then horizon has to be minimum 5 years and above. And for the last 5 years, of course, we've seen super phenomenal, SIP returns at 20%. 10-year returns now stand at about 15.5%. But like Santhosh mentioned, please don't chase the past returns for the right reasons. If you're buying, great.
15.5%. I don't think it's a stretch to say that beats the benchmark Nifty 50.
It has beaten.
But thank you so much to the both of you for joining in, and it's been an absolute pleasure. All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. Do stay tuned. This is NDTV Profit.